Good afternoon, tradeologists. I think it would be helpful to kind of go over some of the trades that we do that form the portfolio that we're trying to build here. In the videos and the modules, I talk a lot about some different types of trades that we use to build our portfolio and then manage those by the numbers. And those trades are iron condor, calendar, double calendar, vertical spreads, and we haven't talked about double diagonals, but we have talked about the iron condor, the calendar, the double calendar, and vertical spreads. So it might be helpful to do this video just to show you exactly what those positions are, what kind of trades those are, and how they make money, and why we use them. So that's what I'm going to try to do today, is just kind of go over each one of those individual trades and just kind of give you a sense of how those trades are put on and why we do those. So let's go to our trade tab for a second in Thinkorswim. Now I use the Thinkorswim platform, and this is pretty much the way you're going to see the Thinkorswim platform when you open it up for the first time. But if you don't, you can always go to this Setup tab up in the top right hand corner. Just click Setup. You can have it display all of your accounts, just some of your accounts, which default account you want it to go to. I have 2 accounts on here. The position main layout, you really want to see the delta, the gamma, the theta, and the vega. You can also select net share, strike price, net change, and percent change, and I'll show you what that looks like if you say OK. It changes these, and we no longer have our Greeks here. Instead, we have net share, strike price, net change, percent change, etc. I don't like that setup, because what we do is we manage by the numbers, and the numbers are the delta, the gamma, the theta, and the vega. So that's how I have that open. Also, we want to see the profit and loss open in the day. You can go open year to date. You can go date, year to date, date open, percentages, and so forth. But I like the open in the day. You can also set the margin requirement or the buying effect of the positions that you have on. So in other words, how much it reduces your buying effect or how much it increases your buying effect, etc. I like to see the margin, because I calculate my returns based on the return on margin. Group positions by the instrument, or you could do it by the trade time that you did it. You can also select whether or not you want to mark the ITM, which is in the money positions, 2 weeks before expiration, a week before expiration, or 4 weeks before expiration. I just selected as a default 2 weeks before expiration. Lines in the position table, I really don't play around. Volatility strategy implied, I want the individual implied volatility. You can also select volatility smile approximation or fixed volatility per expiration date. But I like the implied volatility on the individual options, so I just selected that. My default stock order quantity is 500. You can select whatever instrument, but you can always change that. You select 500 to begin with, and then you can increase that as you go. The stock order quantity increment is 100, so if you toggle up, let's see, if you select a stock that you want to buy, it automatically puts 500 shares in as your initial buy into the trade order tab. And then if you toggle up, it'll go up by 100 shares at a time. The default futures, I don't do anything with futures yet. I don't really care for futures that much, to be honest with you. The default option order quantity is 1, and that allows me to collect, either put in there 1, 2, or 3, or 5, or 10, or whatever, because then what I do is I just toggle the number that I want. Some other things here. You want to show the order confirmation tab. I think you want to show that. You don't want to just submit orders automatically. You want to make sure that that's selected as yes. Then you clear the order after the send. After you send it, the order is cleared from the tab, but it's still in the order queue, so you can still see it. I want real time, no delay on the quote speed. And some of these other things, the hints on the mouse, yeah, you can use those in your nickname. So you just click OK on that, and it sets everything up for you. And that's the way I have my Thinkorswim platform set up. And I think it's the easiest one for me to use because, you know, when I go into a trade, let's say we go from the monitor tab over to the trade tab when we want to place orders. So let's say I wanted to place an order in LMT. I just put in LMT and then I hit enter. And what it'll do is it'll bring down all of the options available for LMT at any given time. So right now the June options are available, the July. Now what they do is they do the Junes and they do the year that they are in, because you have some options that are in January of 2009 and you have some that expire January 2010. Those are the leap options, really long-term options. And then if you just click these little arrows, you can open up and see the available number of strikes that are available for that option. And you can set the number of strikes that are open by this little box over in the right hand corner here. You know, if you only want 10 open, or you only want like the ones right around the money open, you can open just 2 of those. But I like to open up as many as possible so I can see all of the available options. And if you want to close that up, you can just right click on the little blue arrow and then open up another one. If I wanted to see September's options, I can open that up and take a look. So specifically now, let's take a look at, let's go to an index like IWM, which is one of my favorite index options to use. I currently have a position on the IWM now, which is way up here, and but that's because, I mean, usually I do spread positions, and when we talk about doing an iron condor, a calendar, a double calendar, or a vertical spread, those are all spread positions. And a spread position is simply the sale of one option and the purchase of another option. Normally, the sale of the option is there, and then the purchase of another option is to protect the sale of that option. Most brokerage firms, unless you have a great deal of equity in your account, or you have professional experience, do not allow you to sell options what they call naked. And that means that you're selling an option without having a corresponding option that you've purchased in order to protect the sale of that short option. So they don't allow you to do that unless you're a professional trader or you have a large equity in your account. The spreads are basically, here I'll give you an example. Now remember, if you're selling an option, you're going to be selling an option at the bid price. Let's just take these calls for a second on the IWM. When you purchase a call, you're going to buy it at the ask price. If you're selling an option, you're going to sell it at the bid price. So if we're doing a spread, let's say we want to do a very simple, what was the first, let me take the most basic and simple spread order that you can possibly take. And really, this particular spread, called a vertical spread, is probably the basis of almost every single option trade that you'll ever make, because they're based on this one type of spread, the vertical spread. Almost all the other spreads that we use, including iron condors, calendars, and double calendars, and even double diagonals, and some other sophisticated trades, including back ratio spreads, are all just a variation on the vertical spread. So, for example, now we can simply, in the Thinkorswim platform, we can simply right click on these and go to buy vertical. And that will give us our vertical spread. But before I do that, I want to show you exactly what it means to buy a vertical spread. Let's say we're bullish on this particular index, the IWM, and we believe it's going to go up in price. We have a couple of different options available to us. No pun intended there. First, we can purchase an outright call, and you can see as I hover my mouse over this $1.98 price call, which is the June 72 call, I can simply left click on that and it automatically brings up the order entry box purchasing 1 of the June 2008. That's the date it expires, in June of 2008. The strike price is 72. It's a call, which means that we will profit if the underlying index goes up in price, for $1.98, which is the current price. And it's a limit order. In other words, it's an order that we don't want to pay more than $1.98. Now, if you can set all kinds of different orders here. You can set market, limit. If you select market and you submit that as an order, if that price changes to like $3 all of a sudden, like 2 seconds, well, you're going to pay $3 for that. So I always enter my orders as limits. I want to see if I can get it at that particular price. And if I can't, then I can always change my order, but I don't want to pay more than $1.98. And that limits me to the amount that I actually pay when I submit that order. And you can submit this order for the day. You can submit it good till canceled. In other words, if you submit an order to purchase this June 72 call, one of these at $1.98, and you select day, that means that they will try to get you that price the entire day until the market closes. If the market doesn't give you that price, then the order automatically expires at the end of the trading day, and you won't have that order in the very next day. It will cancel. It will just be over. They'll terminate the order, and you'd have to order if you wanted to continue to purchase that option the very next day. You'd have to put the order in again. But you can also submit your order as GTC, or good till canceled. And that means that when you submit this order, and we'll just click OK here, it changes to, instead of a day order, it changes to good till canceled. That means that this order will stay on the brokerage firm's computers and will be executed at any time today, tomorrow, a week from now, or even 2 weeks from now, until this option expires for $1.98. Generally, I don't like to do those kind of orders because they're just too long for me. Normally, I do day orders. But you also have the option, I guess, of doing an extended hours order. But normally, those are only during extended hours. I normally go with day. And the reason is, normally if I put in an order for this particular option and within 5 minutes I don't get filled at the price I want, I cancel the order. I don't like to hold that order for more than a few minutes. The reason is that the market can change dramatically. Maybe I can get it at a lower price. But normally, if you're just buying or selling a single order, the reason that that there's an asking price here of $1.98 is that the market makers have quoted this as a price in which they will sell this option for $1.98. If they were not willing to sell it at $1.98, they would not have a quote of $1.98 here. So on a single option order, you can submit this. And as long as the price doesn't move dramatically, they will fill that order instantly at $1.98. Now, on some options, you can actually ask for a mid-price order. Now, this is during the weekend after the markets are closed, and the bid and ask are a little bit farther apart than they normally are on the IWM. Usually, they're like a penny or 2 cents apart. So you're going to buy at the asking price, and you're going to sell at the bid price, and there's nothing in the middle of that. There's no mid price on single options. Um, but I mean, you could go down if they did have a wide enough spread. You could go down maybe a penny. You can see what I did here. The platform of TOS always shows what the natural price is and what the mid price is. So you could try to split the price and get it down to $1.97 or even $1.96, which is the middle price between the $1.94 bid and the $1.98 ask. And sometimes it pays if you're trying to trade an option that has an extremely wide bid. Let me pull one up that does have an extremely wide bid on this. Here's a stock I've been following for a while. Is EDU. It's a New Oriental Education and Technology company, and what they do is they train kids in China. It's kind of like a private school, a private tutoring company for Chinese children in China, to help them better in school. And of course, the Chinese are very, very aware and concerned about the education of their children. They put a lot of money into, if they have it, they put a lot of money into the education of their children. They feel that's the best way for them to advance. And so this company is taking advantage of that trend in China. And I've been watching this stock for quite a while. It's one of my favorites. The bid and ask on these can be quite large. In this case, let's take a look at the June 80 calls. The bid is $1.70. The asking is $1.85. And even though we're on the weekend, normally the bid and ask price are at least 10 cents apart. So this is maybe $1.75 to $1.85 during market hours. And you could put in an order instead of paying $1.85 for that. You could put in an order to buy it at $1.80, which is the mid price, saving yourself 5 cents. Now, on a single lot of this call option, that won't save you a lot of money. But if you were to do larger numbers, the savings could be significant. On a 10-lot order, the savings would be about $50. On a 1-lot order, the savings is $5. And guess what? $5 is still $5. So, if you can get it at the mid price, I would submit it. I mean, if I were to purchase this option, I would always go in the mid price and see if I can get it for $1.80 instead of paying the natural price of $1.85. You can also look at these prices as being either retail prices and wholesale prices. I look at the mid prices as wholesale prices, and the natural price is really the retail price of that option. And if you didn't know anything and you didn't take this training, then you would always pay the natural price or the retail price for those options. But every once in a while, are you going to get the mid price all the time? No. You may not get it even 20% or 30% of the time. But, the times that you do get it, if you get it 20% of the time, it's going to save you a lot of money on your options that you're purchasing over time. So it's always worth trying to get the mid price on any option. Okay, let's move on. We have that's just a very short little example of how a single single option is priced and how orders are entered and what they mean and how you profit from them. Remember, if the underlying stock here, in this case EDU, goes up, this option will increase in value. Let's say it goes up $5. It's currently at $75. And if it goes up $5, what will happen to the price of this option? Well, what will happen is that if it goes up $5, we can take a look at, now the stock is at 70 or 85 rather, instead of 75, or no, I'm sorry. It, it's currently at 75. So it goes up $5. It's currently at $80. Then that $1.85 option will go $5 further into the money, and it will be worth approximately $4.10 because it's $5. Right now, the stock is at 75, and the 75 call is at $4.10. If it moves up $5, then that call will now also be worth $4.10. That call will be now the 75 call will move up, and it will be worth $7.30. So that's why people buy call options, because if they believe the stock will go up in price, they will profit from it. So why do we do spreads instead of buying single calls then, or single puts? The reason is that our risk is a lot less. For example, if we were to purchase this call option for $1.85, if the stock moves against us and the stock actually moves down instead of moving up, now let's say it moves down by $5. Now what happens to our call option? Well, now it's only worth 70 cents. We've lost $1, almost $1.10, $1.05 of the option price. That's almost 50% of the option price. So normally what we like to do is create what we call spreads. And a simple spread order is simply the purchase of one option. And what we need to do here is, in order for me to show you this, we need to select the Advanced Order tab from Single Order to Blast All, just so that we can show all of the options that we're purchasing. Here, let me show you what happens if you have it on Single Order. We can buy that, and then let's say we want to sell this one. Well, it just changed it. We didn't get both of the orders in there. So we need to change this to Blast All. And then what we're going to do is we're going to create a very simple vertical spread. A simple vertical spread. Let's say we take the 75 call, we buy that, and in order to protect our investment, we want to sell an option at a strike price just higher than that. And this is called a vertical spread. We're buying one option, we're selling another, and that will protect us, okay, from a downturn in the market. Because what will happen is if the price of this option, if the price of the underlying stock goes up, this option that we purchased, the 75 call in this case, will increase in value greater than the one that we sold, in this case the June 80 call. We sell the June 80 call, and we'll make money on the June 80 call if the market goes down, and it will help protect the price that we paid for the 75 call. We'll still lose money on this position, but we won't lose as much as if we had just purchased the 75 call alone. And if the market goes up in the direction we anticipated, then the 75 call will increase in value greater than the money that we've lost on the 80 call that we've sold. So let's take a look quickly at this particular spread. We're buying one call, we're selling one call. The difference in this, I should remind you, this is in the same month, this is in June. And the strike price of the one that we're buying is 75. The one that we're selling is 80. The difference between these two is 5 points. So this is considered a 5-point spread, vertical spread, 5-point vertical spread. The vertical means that it's in the same month and in the same option. Okay, they're both call options. Now, if we were to take the $4.10 and subtract it from the $1.70, because we're selling that one, we're actually receiving a credit of $1.70. We're paying $4.10 for the call option, but we get a credit of $1.70. If we subtract those two, that is what we pay as a debit for this particular spread. So $4.10 minus $1.70 is $2.40. That's what we would pay to put this spread on, this vertical spread. It's also called a bullish vertical spread because we are making a directional play here. We are anticipating that the stock is going to go up. So this 75 call, this 80 call, it's a $5 vertical spread or a bull call spread, and that means that if in fact the stock does go up, we will make money. How much money will we make? Well, we just calculated the difference in these two prices, and it comes to $2.40. The difference between the strike prices is $5. The difference between the $5 strikes and the $2.40 that we purchased this spread for is $2.60. $2.60, if we hold this all the way to the expiration in June, is the maximum amount of money that we'll make on this spread. So you can see that vertical call spreads are, their advantages are that we protect our long call with the sale of another call above the strike price, and that helps to bring in a little bit of premium because we're paying $4.10 for this. We're taking in, we actually get this deposited into our account, the $1.70 into our account, making our net debit here $2.40 for this spread that can be worth $5 at expiration. So our maximum profit is $2.60. So, like I said, we have a spread here that's $2.40. Now, our maximum profit is $2.60. But for us to enter these positions individually, we're paying basically the retail prices. We're collecting the $1.70, which is the bid price. We're paying $4.10, which is the asking price. So the $2.40 for this spread is the retail price of this spread. Let me close this out for a second. Remember the $2.40 it costs to put on this spread. Just remember that for just a second. Instead of entering those orders individually, what we can do is right-click on the option that we want to buy, go over to Buy Vertical, and we can see that it brings up both the option that we want to buy and the option that we want to sell in the same order entry box. And now we can enter this order as a spread, and the mid price is $2.20. The natural price is $2.40. Remember, the $2.40 was the amount that we had entered, the amount of the spread when we clicked on each individual option. So we have the option, though, when we bring these up as a vertical spread and enter this order as a spread rather than individually, we can actually have the opportunity of purchasing this spread for $2.20, which is the mid price between these two set of options, saving us 20 cents on this particular option. Now let's just, for an example, we're only using one contract here, but let's go ahead and confirm and send this and bring up that dialog box. It will cost us $240 if we were paying the retail price, which is the natural price for this, plus a $3 commission, and it will cost us $243 to enter this order. As I mentioned, if we're paying $2.40 or $240 for the spread, the strike price difference between these two options is $5. So our maximum profit is $2.40 minus the $5, which is the difference between these strikes, which is $2.60. And that's exactly how they calculated our maximum profit in the dialog box. Our maximum profit is $2.60 on this spread. Our maximum loss is $2.40 or $240, which is $2.40 per spread, which is the exact amount that we paid for the spread. Okay, so the most you can lose in a vertical spread is exactly what you paid for it. That's the maximum amount of money that you could lose. You can't lose any more than that. But you might be asking yourself, well, especially if you're a total beginner to options, is if the price is $2.40 and we're only buying one contract, why are we paying $240? Well, the reason that we're paying $240 and not $2.40 is because each contract, and this is true for every single option except for some exotic European options or some other exchange options. It's true for the majority of the stocks or indexes that you'll be buying, is that a single option contract, actually gives you the right to purchase 100 shares of the underlying stock up to the expiration date. So one contract is actually equal to 100 shares of stock. So when you look at a price of an option, or in this case the price of a spread, you would take the $2.40 that you're paying for the contract, multiply it by 100 to determine what your actual cost of that option, or in this case the spread, is. And that's why we're paying $240 and not $2.43 or $2.40. So that is also, that's exactly how you would determine your break-even points, your profit on this position, your maximum loss, and the cost of the trade. Now, remember this cost of $240 plus $3 in commission for a $243 total cost. Let's close this out just for a second. What happens if we try to get this at the mid price? Well, if we try to get this at the mid price, which is considered to be a wholesale pricing, our maximum profit now has jumped from $260 to $280. That's because our maximum cost of the trade is now only $220. If we take the $2.20 and subtract it from the $5 of our vertical spread, well, now we have a potential profit of $280 on that spread. And since it's only costing us $220, our maximum loss now is also $220. With the $3 commission, it's going to cost us $223. So it actually saved us, by trying to enter this order as a spread instead of individual orders of the options, it saved us $20 on this one order. Okay, that may not seem like a lot. However, if you enter enough of these orders over the period of a year, that $20 can add up very, very quickly. Let's just give you an example. If you were to put a 10 lot on these, let's see what the difference in the price is. If we were to enter this at the retail price of $2.40, we would be paying $2,400 plus $30 in commissions, or $2,430. Our maximum profit is $2,600. If we bought this at the mid price, we have shaved $200 off the price of our spread, and now our profit is $2,800. Our maximum loss is only $2,200, which is the cost of the spread plus the commissions, or $2,230. So you can see that not only does trying to get the mid price help us save money, it's really wholesale pricing of the options. Now, like I said, you're not always going to get it at the mid price, but guess what? You could even shave the difference between the mid price and the natural price and try for $2.30. If you couldn't get it at the mid price in the beginning, you'd still save quite a bit of money on this 10 lot order. It's a $100 savings if you can get it cheaper. Even on a 1 lot order, you could save $10, and those dollars do add up. So that's a very, very basic understanding of spread orders and why we do spread orders. Let me just show you one additional feature of and benefit of entering spread orders instead of individual option orders. Let's take this out for a second. I'm going to go back to here, and let's say we wanted to enter the spread as individual options. So we're buying that one, we are selling that one. When we enter these orders, we have a couple of different options available to us in our dialog box. We can blast all, we can have a first triggers sequence, or we can have a first triggers all. So if we purchase this one, then it will trigger the sale of this one. But what happens if the market accepts the order on this price, but it doesn't accept the order on this one? So it accepts the order that we're buying, but the price moved after this one was entered, and now we can't get this one for $1.70. Well, what happens to our spread? Our spread may widen or it may decrease. We don't know, but we're not going to get the other leg of this order in, and all of a sudden, instead of paying $2.40 for this order, we may have to pay $2.50 or more for this order, or the price may go against us, and all of a sudden our long call here may be worth less money, and we didn't have the protection of this short call in order to help offset the loss on this long call. The calls that we are buying are called long. Usually they're long, whatever, long calls, long puts. Those are the ones we're buying. The ones that we're selling, we call those short. So we're either short the call or short the put. Those are the ones that we're selling. That's just the terminology that people use when describing if they're long a call or short a call. So you can see that when you put in these type of orders, that if you do them individually, you have more risk than if you put them in as a vertical spread order. You may get a higher price or a lower price if you try to play around with it, but if the market moves dramatically against you, then you might get hurt. You might end up paying a lot more for that spread than you should have, or the price will move against you and you'll lose money. So it's always best to put these orders in as a spread. You'll always get the best price, the best execution, and you don't have to pay retail prices unless, of course, the market is not going to be very forgiving, and then you try to, but at least you can always try to get the mid price or the wholesale price before you start raising your prices in order to get the position on. So that is a vertical spread. That is a simple vertical spread where you're purchasing one call and selling another. We can do the same thing on the put side. We can also buy a vertical spread on the put side. So instead of calls, if we believe that the market is in the stock is going down, if we believe the stock is going down, we can purchase one put at a higher strike price, sell a put at a lower strike price. In this case, it's the 80-75, and we call this a bearish vertical spread because we're buying puts and we want to profit when the stock goes down. In this case, the debit is $2.85, which gives us a profit of $2.15, which is the difference between the strike prices, which is $5 minus the $2.85 that we paid for the vertical spread. And it gives us a profit of $2.15 if the stock moves down below 75 or below on expiration. So if we go ahead and bring up the dialog box here for the order confirmation, you can see that the maximum profit is $2.15. Maximum loss is exactly what we paid for the spread, $2.85. And the cost of everything is $288. So whether you're buying calls or you're buying puts, this is the basic vertical spread is the basis for almost all of the trades that we put on. Almost all of them. In fact, is the basis for the calendar. It's the basis for the iron condor. It's the basis for the double calendar. It's a basis for double diagonals. It's the basis for the sale of vertical spreads. So you see that we can profit from a vertical spread when we are buying a lower on the call side, if we're buying the lower strike price and we're selling the higher strike price. But we can also do the reverse. Let's say, for example, we're interested in profiting in a different way, and we're interested in collecting premium on this particular option. If we were to sell a vertical spread, that we would profit when prices moved in the opposite direction. Let me just give you an example of how you would enter that order. So the sale of a vertical spread involves the sale of an option and the purchase of an option, just like a regular vertical spread. The only difference is, instead of buying one at a lower strike price if we're doing calls and selling one at a higher strike price, we reverse the process and we sell one at a higher strike price. I'm sorry, at the lower strike price, and buy the one at the higher strike price. So instead of going to buy vertical, as we would on a normal vertical spread, we actually go to sell vertical. And in this case, what happens is we receive a credit of $2.15. And because this is a $5 wide strike, and we're receiving a $2.15 credit, then what is the maximum loss on this position? Well, the maximum gain is the $2.15 credit that we received when we put this position on. The maximum loss is the difference between the $5 strike and the $2.15 credit that we will receive, which is $2.85. So the maximum loss is $2.85. The maximum gain is $2.15. And if we bring up the confirmation dialog box, you can see that they have the exact same numbers. The maximum profit is $2.15, or $215, and the maximum loss is $285, which is the difference between the strike prices minus the credit we receive. And so we would receive a credit. You can see that it's a credit of $215 minus the $3 in commissions that we pay for a net credit of $212. What is the difference then? I mean, why would you do this rather than just buying the vertical spread as we had in our previous discussion? Well, in this case, the stock has to move up in order for us to profit. If the stock stayed exactly the same at $75.20, then the stock, then we would lose value in this option. These options would both lose value. How do we know that? Well, if we look over to the left here at extrinsic, the extrinsic value of the option is $3.75. In other words, there is no actual intrinsic value in this option. It's not in the money. It is at the money. This is considered an at the money option. Therefore, the price that you're paying for this option is all time value. The time value of an option is the amount of value that that option has if it were to go to expiration and the price remained at $75, there would be no value at all to this option, right? Because what we're doing is we're saying, okay, if a single contract, this is a very, very important concept to understand. If a single contract gives you the right Now this is a call we're talking about. A single call contract gives you the right to purchase 100 shares of stock at the strike price of $75, or in other words, you have the right to buy 100 shares of stock at $75. And this went to expiration, which is the third week in June. Why would this option have any value at all to you? Because you could buy it at $75, but the price of the stock is $75. There's no benefit to you of owning this option if the stock is at $75. Now, if the stock is at $80 and you had the right to buy it at $75, then your option will be worth $5 at expiration, and everybody else has to pay $80 for that stock, but you could exercise what they call exercise the option and purchase the stock for $75, giving you an immediate $5 profit. That's the power of options. Options give you the right to buy the stock at a future date. Now, many people don't even bother to exercise their options. They simply sell their option at a profit. For example, let's say you purchase this $90 strike price option for 20 cents. Well, if the stock moved up to $95, that 20-cent option is now worth $5. That's a tremendous profit. If you were to purchase 10 contracts of that, it would cost you $200. At expiration, if the stock is selling at $95, that option will be worth $5. It's the difference between these two strike prices. $95 minus $90 is $5. That's how they value the option. That option at $5 is now worth, because you bought 10 contracts, is now worth $5,000. So a $200 option you purchased today, if the stock was to go up to 95, would be worth $5,000. Most people would not exercise their options to buy the stock unless that was their goal, but they would simply sell the option back to the market for $5, capturing that $4.80 profit. So why would you sell it? Well, like I said, if on a bull call spread, you hope to be able to have the stock rise past your short strike until at expiration, so that you can collect the full and maximum profit of that spread of $5 at expiration. In this case, we're buying the spread for $2.20. At expiration, that spread will be worth $5, making us a $2.80 profit. But what happens if it doesn't move? What happens if the stock stays at $75? Well, we'll just round it off to $75 for this example. Well, that $3.75 of intrinsic value in this option, or the $4.10 that we purchased, will be worthless at expiration. We will have lost all $4.10 that we paid for it. Not only that, but our option that we sold at 80 cents, at the $80 strike price for $1.70, will also be completely worthless. That's why the maximum loss of a bull call spread is the debit that you paid for it. We will have actually made a profit of $1.70 on this one because we sold it, and if we can buy it back for $0, we keep the difference as our profit. In the case of this option, we bought it for $4.10, so we lost the maximum, or $4.10 on this option. So we gained $1.70 on that one, we lost $4.10 on that one, which gives us, actually, because we're using retail prices here, a maximum loss of $2.40, but we're going to try to hit the mid price, so our maximum loss is $2.20. But the difference is you lose whatever you paid for this spread. Now, When we do the opposite, we actually sell the vertical. We collect a credit of $2.15. Now, what happens if the stock stays the same? It does not move, and it's $75 at expiration. Well, if it is $75 at expiration, we get to keep the maximum credit that we put this trade on for, which is $2.15. When we go to sell it back, when we go to purchase these options, we're purchasing back the 75 and we're selling the 80, we're selling the spread. We hope to sell it for nothing. Hopefully we can just let it expire and we collect the maximum profit. We know ahead of time what our maximum profit is going to be. In this case, it's $2.15. That's the most that we can make on this trade. And our maximum loss is $2.85. How would the maximum loss be achieved? If the stock were to rally up past the 75 and close above $80, we will, which is the price at our long call, then we will have lost. This spread will be worth $5, and we will have made our maximum loss, which was $2.85, because $2.15 minus the difference in the strike prices is $2.85. That's our maximum loss. If we bring up the dialog box again, you'll see that the maximum loss is $2.85, or $285. So why would we sell rather than buy these spreads? Well, I'll show you. Let's go to, and I just right click on this order dialog box and go to Analyze Duplicate Trade. Let's take a look at this. When we sell a spread, I want you to take a look at something very interesting. We manage our business based on the numbers. So when we receive credits on a spread order, because we're selling an option that is more expensive than the one we're buying, we're going to have a negative delta. Remember, when you buy a call option, you'll have a positive delta. When you sell a call option, you'll have a negative delta. In this case, we sold one that was more expensive than the one we bought. Remember, we like to buy low, sell high. That's what all good businesses do. So we will have a negative delta. But more importantly, we will have a positive theta. In this case, $1.08. Which means that as time progresses, as we get closer and closer to expiration, we would hope to achieve $1.08 profit every single day that we hold this position, given that prices would remain relatively stable. If we take a look at this profit picture, this is a graph of this particular spread, and it gives, the profit picture gives us two lines by default. One line, the green line, is what our maximum loss and our maximum profit would be at the expiration of this spread. The current price is right here at $75.20. So you can see that as soon as we put this position on, we have a small loss. And that has to do with the fact that there is the difference between the natural price and the mid price. Every time you put on one of these positions, you're going to have a very small loss as soon as you put it on. The market makers, I guess, have to make a profit somewhere. And that's where they do it, on the spreads. If the price moves in the direction that we anticipate and it goes down, we will make profits as this particular stock moves down in price, because these options will become less valuable and we will achieve a greater profit. If the stock were to move up, since the one that we sold was more expensive than the one we bought, we will be in a losing position. And the price of this stock will continue to if it goes up, our spread will continue to lose money until we've reached our maximum loss of $285. What happens though, see, with the sale of a vertical spread, we get positive theta. Theta is the decay of the option over time that progresses until expiration. Theta will increase in time as we get closer to expiration. And what happens if the price of the stock does not move though? And it stays exactly the same. Well, if you take a look at the graph, if we keep this spread on until expiration, we will achieve a $195 profit, which is right up here. That's one of the advantages of a selling of a vertical spread. The stock either goes in the direction we want it to go in, or it can stay the same and we still achieve a very nice profit. We have two opportunities to profit. Remember, a stock can only go down, it can go up, or it can stay the same. In our case, we win 2 out of 3 times, 2 out of 3 of these chances, because if it stays the same or if it goes in the direction we want it to, we profit. The only thing we don't do is profit when it goes in one direction, up. Now, let's take a look at a regular vertical spread. The purchase of a vertical spread. Let's buy this vertical spread and then analyze it on the same graph. It is exactly the opposite picture of the one that we just had up, in which we sold a vertical spread. Instead of a negative delta, we now have a positive delta, which means that it's positive because the one that we bought is more expensive than the one that we sold. So in reality, each one of these options has its own delta. Well, since we're long an expensive option and we're short a cheaper option, the positive delta that we get from the 75 call is subtracted from the delta of the negative call of the call that we sold short, creating a positive delta. But because we have a positive delta, we also have a negative theta. In other words, remember there were two scenarios in which we could profit when we sold a vertical spread. If the price stayed the same, we profited, and if it went in the direction we wanted to, which was down, we profited. So 2 out of 3 scenarios we profit. In this case, when we buy a vertical spread, the only possible profit potential that we have is if the price of the stock moves up. In fact, not only does it have to move up, but it would have to move up fairly significantly. In fact, to achieve the minimum that it would have to go up to achieve our maximum profit would be $80 right here. After $80, we continue to receive our maximum profit, but in order for it to achieve the maximum profit, it has to rise by $5 before the expiration date. So it has to do something. If the stock just stayed the same at the same price, we would lose almost our entire investment. Or if it went down against the direction we hoped it would go, we would also lose our maximum investment. So that's the difference really between the sale of a vertical spread and the purchase of a vertical spread. There are only two options in here, and they give you a different profit scenario. The profit scenario for the sale of a vertical spread is that, and let's just switch these around here. We can go sell on this and buy on this, just to show you exactly what happens. If the stock stayed the same or went in our direction, we profit. The only way we would lose is if it goes against us in direction. Again, the delta would be a negative figure, and our theta would be positive. For the majority of the trades that we're making, we want positive theta. We want theta to be positive at all times. And if theta is not positive, then it gives us a sign that we should probably exit our trades or put on other trades that would give us a positive theta. Why positive theta? Well, remember, there's only two truths to the market. Number one, prices will fluctuate. And number two, all options expire. On the whole, if theta is positive, and we go towards expiration, we will collect more and more of the time value of that option to our account. That's why we always like to sell options that have extrinsic value. The option with the highest extrinsic value is always the at-the-money option. And you can see that it's true here. The time value in the highest theta would be achieved by selling this option at $75 strike price. And you can see it's not only true for the calls, but it's also true for puts. This has a $3.55 extrinsic value on the put side. And if we were to sell both of the calls and the puts at the money, we would achieve a fairly significant amount of theta. Let's just take a look at that. Let's sell that, and let's sell this one. We would achieve close to let's see, $3.80 and $3.40 is $7.20. That's a significant amount of time value that we could collect if we were to sell both of those options. In fact, that is the maximum amount of time value and the highest theta that we could possibly achieve in this particular stock. Let's delete those for a second for this month. If you put on a strategy like that, you could easily do it by going to sell, straddle. And you can see that it once again gives us the mid price of $7.50. And if we took a look at a graph of this, let's analyze this as a duplicate trade and bring up our Analyze tab. You can see that if the price stayed relatively stable, we would have the maximum profit of close to, oops, I got to get rid of that other one. Hold on. There we go. We would have a maximum profit right here of close to $750, which is the amount of credit that we received. It also has a fairly wide break even. In other words, the stock could move from approximately $67 on the downside before we hit our break even point, or it could go to $82 on the upside as our break even point. So it looks like the sale of a credit spread is a very good trade if the stock is going to be the sale of a this is the sale of a straddle, which is the most time premium that we can get in the month of June, would achieve a very nice profit if the price went up a little bit, went down a little bit, or stayed the same. We could achieve a very nice profit on this position. The problem, of course, is that any time you are selling options, you are considered naked those options. When you are naked those options, you have a position in which you could have an unlimited loss. And that is not a good position to be in. Just to prove that that is true, let's shorten up this price a little bit, and I will show you exactly what happens. Here we are at the price. If the price were to move up to 90 and keep going, you could see that in fact the losses would be incredible. Of course, in real life, you may not have those kind of risks, because a stock theoretically could go to infinity in price, but in reality it probably would not. You could see that as long as we continue, we would lose more and more money in a linear fashion. So if the stock went from $75 up to $500, we would lose $42,000. And that's not a pleasant situation to be in. Now you might think, well, that's probably impossible. The stock at $75 would never go to $500. However, I can think of a couple of situations in which a stock at $75 could potentially go to $100, $150 or more, resulting in a tremendous loss on these positions. And that is if the company is being bought out, is merging with another company, or an offer to buy the shares of the stock are made on that company. There are a number of factors that could affect the price of those options, and if you're naked those options, theoretically you have an unlimited loss potential for those options. That's why we never sell naked options, and we always do spreads. Now, instead of, if we wanted to capture the maximum amount of time value in these options, rather than just selling those options, let's do the sale of a vertical. We're still selling the 75 call to capture the maximum amount of extrinsic value. But now we're also purchasing a call at the 80 strike price to protect our position from having a huge loss that could potentially be unlimited. Let's also do it on the put side. We're also going to sell a vertical. You notice that we have the same straddle that we had before at the 75 call and the 75 put. The difference is we're also purchasing now a call to protect our position and a put to protect our puts of the sale of our 75 put. Let's analyze these positions. Remember this graph. Let's go back. Now we're going to put both positions on, creating a spread, the sale of a straddle with protected wings. It looks pretty much the same as the other graph, doesn't it? The profit potential is slightly less. Instead of making a maximum of $750, we're only making a maximum of approximately $400. So our profit's a little bit less. However, when you take a look at the potential loss, and if we do get into a situation in which this company is rumored as a takeover target, and the price suddenly jumps from 75 to over $250, well, our maximum loss, it doesn't matter how high the stock goes, our maximum loss is only $109. It doesn't matter. This stock could go to $1,000 and we're still only going to lose $100. That's why spreads are preferred by professional traders over selling of naked options to collect theta. I wanted to show you just one more thing here. That is true for both the upside and the downside on this position. The most we can lose on the downside is $110. And it doesn't matter how low the stock goes. What happens if the stock all of a sudden collapses completely? You would still lose only a maximum of $110. That's why we prefer spreads to the purchase or sale of individual options. Now, even so, even though we have limited upside potential, we have extremely limited downside potential because our maximum loss on this position is only $110. But look at our break-evens. We have break-evens at 71 and we have break-evens at 79. We have a tremendously wide break-even on this position. In fact, we cannot lose on both sides of this position. we can only lose on one side. The other side will actually make a profit. Let's do this just as a just kind of as a learning lesson here. We have a fairly wide range in which the stock can move, and we can achieve our maximum profit if the stock moves within this range at expiration. Remember that this green line represents the maximum profit we can achieve at the expiration date. This white line is the amount of profit or loss that we can achieve at this particular moment in time. So as of today, if we put this spread on, yes, we'd have an immediate loss of $3.83 on one contract. Remember, we're always on credit spreads, we're always going to have a loss immediately when we put it on, and that basically represents the marker's spread and their actual profit when they sold it to us. So, and it also includes the spread between the bid and the ask, which theoretically the market makers actually make money on. I'm not saying they actually do, because sometimes they don't, but that is their theoretical profit. What happens when we take one of these side spreads off? If you go down here to the Analyze tab under the Positions and Simulated Trades, if we just unchecked one of these boxes, what it'll do is it'll take that position off of our profit picture here. So let's take that off. And you can see that now if we only have the one vertical spread on there, if the stock stayed the same or went up, we would receive the maximum credit. If it goes against us and goes down, then we will achieve the maximum loss. The maximum loss in this case is $325. The maximum gain is $175 because we sold this spread for a $1.75 credit. You can do that. If you have a strong belief about the future potential of the stock, you can in fact do just one side of the vertical spread. However, in most cases, and I know this includes myself, I'm not very good at predicting price. Although I do have some unique tools and experience doing technical analysis, many times you just don't know. I mean, you think something is going up, it doesn't, or it just stays the same and it just wears away at your position. That's why we tend to do double spreads. In this case, a double vertical spread. This is very similar to an iron condor. Very similar. This is actually the sale of a straddle with protection. Now the protection of it is the call that we bought at a slightly higher strike price, and the put that we purchased at a slightly lower strike price. So you can see exactly what this looks like. Now let's take a look at what an iron condor would look like. We've already talked about how we do vertical spreads to collect a premium. Normally an iron condor is the sale of a vertical spread on the call side and the sale of a vertical spread on the put side. So you've got a sale of a vertical spread, and I'm just going to change this to the 80s and the 85s. So it's the sale of two out of the money vertical spreads. That's all an iron condor is. Now if we analyze these trades together, we can see that we have a slightly different profit picture than the one we had before. Instead of a very tall peak in the center of our profit picture, we actually have a long horizontal line here that indicates our potential profit in this position. Our break-evens are extended to 68 and to 82. It's a bit wider of a profit range in which we can move. And the majority of professional traders like this better than the sale of a straddle with wings as protection, because they do have this very wide profit potential picture. In the case of the sale of the straddle, I think our break even on the low point was around 71 and around 80 on the high end. This gives us a little bit wider profit potential and break even points at 82 and about 67 or 68. So a lot of people, a lot of professionals would prefer this as a potential trade. That is an iron condor. That's all it is. An iron condor is the sale of a out of the money vertical call spread and the sale of an out of the money put spread, and that's all it is. So now that you've seen what a iron condor is, let's take a look at a calendar. And you're probably thinking, well, if we're doing iron condors, and let's say we do one on the SPY, which is the SPDRs, the S&P 500 ETF. Let's set up, I did an individual. You can also enter these orders, rather than as individual sale of vertical spreads, you could also enter these as a single order, and you can go ahead and sell iron condor. It's right here. Now, you don't want to buy an iron condor. The purchase of an iron condor is an out of the money bullish call spread and a bearish put spread, and I'll show you the difference here. Sometimes it makes sense to buy an iron condor, which are out of the money vertical spreads. Let's take a look at the profit picture for this. Well, I got to change these strike prices first. In the Thinkorswim platform, the option that you want to put on your spreads at, when you right click, automatically defaults to that particular strike price, but on the call side. But on the put side, you have to change it. So let's say we want to go down to the 133, 132. And 132. Okay, now let's analyze this for a second. Oops, I have a number of different positions on here, so I got to hide my positions. Here we go. With the sale, or I'm sorry, with the purchase of an iron condor, so you can both purchase an iron condor and you can sell an iron condor. With the purchase of an iron condor, the graph is completely opposite of the sale of an iron condor, because at expiration, if the price were to remain stable, you would achieve your maximum loss if the price did not move. If the price moved dramatically, then you would achieve your maximum profit. So the only reason that you would want to buy an iron condor is if you think there's going to be dramatic price movement in the underlying stock, ETF, or future, or whatever it is that you're buying. If the price moves within a very, very narrow range, you will have achieved your maximum loss. Also notice that theta is negative on the purchase of an iron condor, and delta is positive. That's because you're buying a call option and you're selling one at a lower price. So your delta is going to be positive. Let me show you what I mean by positive and negative delta here. On the calls, you have delta. Delta is the rate at which the option will move for every $1 move in the underlying stock. Delta is higher when the option is in the money. For example, let's take this. You can see as you go up here, the further the options are in the money, the higher their delta. What does that mean? Well, let's say the price of the SPYs goes up $1, and we had one of the 133 strike calls. This call is expected to increase in price if the SPYs move up by $1. You take the 0.73 delta, multiply it by the dollar move, and you get a 73-cent increase in the price of that option. That's how that option will move. It will increase by 73 cents. The closer you get to at-the-money options, the lesser the delta. So many people purchase these at-the-money calls, and the delta of the at-the-money call is only 49 cents. So in other words, if the SPYs move up $1, this option will only increase by 50 cents. There is not a dollar for dollar increase in the price of that option as the SPYs move up. The farther you get into the money, you can see that if you purchased an extremely deep in the money option, the delta is 95. Actually, if the price of SPY goes up by $1, this option will increase by 95 cents. Almost perfect one-to-one ratio on the move in the underlyings of this option. So when you purchase an option that has a high delta, 55, and you sell, for example, on this one right here, if we were to buy a vertical spread, and we bought this option that had a delta of 55, and we sold this option that had a 49, all you have to do is subtract these two. The 55 minus the 49 is 6. You would have a positive delta of 0.06 or 6 cents. Let's try it. We're going to buy a vertical spread, and then we're going to analyze it. Let's just get rid of this for a second. And you can see that the delta is a positive 6. It's almost approximately $6. And the theta is negative. Let's go back again, and this time let's sell it. We're going to sell a vertical spread. Now what we're doing is we're selling a call with a higher delta than the one that we're buying. So now we should be very close to a negative $6 in delta and a positive theta. And that's exactly what we have. We have a negative delta and a positive theta. Okay, so what we want to do now, and that's why primarily we tend to sell options rather than buy them. And we sell them for more than we buy them for. That's like what every good business does. As I was saying, we don't want to purchase an iron condor. We want to actually sell an iron condor. In some cases, it does make sense to buy iron condors if you think a very large move in the market is coming. However, in our case, in most cases, we tend to sell iron condors. We're going to be selling the 141 and buying the 142. Why? Well, let's take a look at the deltas for a second. Actually, I'd rather sell this one with a 25 delta. So we're going to go up to the 142, and we're going to sell the 143. I'm sorry, we're going to buy the 143. And on the put side, because it brought up this automatically, on the put side, we're going to go down to a delta of minus 24. Puts always have a negative delta. Calls always have a positive delta. So we're going to sell right around the 24 strike delta, which is the 132 strike. And we're going to buy the 131. as protection. Remember, we don't want to sell naked options. Why would you want to? How did you pick those, Dave? How did you determine which options to sell and which ones to buy? How did you determine where to place your iron condor? Well, generally what we want to do is we want to have a good probability that the iron condor will be profitable. In order for us to do that, we have to take a look at each side of the each individual side of the vertical spread. Since we're selling the 142 and it has a delta of 25, that means if the price were to move against us, there's a likelihood that this is not going to rise very much in price. In fact, for every dollar move in the underlying stock, this is only going to go up by 25 cents. If we were to sell the at-the-money vertical spreads, then we have delta risk, which means that we're going to be moving our short option by 55 cents for every dollar move in the SPY. In addition, we can also determine, let's keep our delta up there, but also let's take a look at the probability of expiring. You can see that the probability that this option will expire, we're doing the 142s here. We're selling the 142s. The delta will help prevent us from increasing the value of this option dramatically if the SPY goes against us and moves towards our position, but also it's very close to the actual probability that this option is going to expire. The probability that it will expire is 23.74% in the money. That probability of expiring is actually the probability of expiring in the money. There's only a 24% chance that it will ever be in the money. We want this to expire absolutely worthless. That's how we capture the majority of our profits. So the actual probability that it will expire worthless is just the opposite of this. Out of 100, if we subtract 23.7 from 100%, it would be what, 76% probability that it's going to expire completely worthless. Those are pretty good odds. You have a 70% chance of making a profit on this position because there's a 70% chance that it will expire worthless. And there's only a 23.7% chance that it will ever be in the money, because if this goes in the money, then we will lose some money, potentially. But let's take a look at a different statistic, which is even more telling. And that is the probability of touching. See, prices do tend to fluctuate. And I mean, that's the whole basis of our training, right? Is that prices will fluctuate. What is the probability that during the time that we're holding this position, that the price of the underlying stock will actually rise up to the 142 level? Well, the probability of it actually coming to touch this 142 strike price is 48%. Okay, so there's a 50-50 chance that the stock will actually rise to the point where it's going to touch that 142. If it does touch that 142, we're going to be in a less profitable position. Now, you can choose options to sell that are extremely far out of the money, that only have a 10% chance of ever being touched by the price. However, you're not going to get the premium that you need to make a profit. I mean, if you were to sell this 147 option for actually you'd be selling it for 12 cents, and you bought protection for 8 cents, you're only making 4 cents on that vertical spread. Or if you were to sell the next one up, if let's say you sold this for 12 cents, you bought the next one up for 10 cents, you're only making a 2-cent profit on that position. That's why I prefer to go with if I'm doing vertical spreads and I'm doing iron condors, I do a 25 delta on the as my sold position, and that gives me a probability of expiring of close to 76%. So that's why I choose these particular options. The same thing on the put side. Normally what I want to do is I want to take a look at the probability of expiring close to 75%, or having a 24 delta, because the delta will protect us if the stock does move down. The increase for every dollar that SPY moves down is only going to be 24 cents. It's not going to kill us. So let's analyze this trade. And I just need to get rid of that one. There we go. This is what an iron condor looks like. At expiration, we make our maximum profit anywhere between 132 and 142. So we've got a pretty wide range in which the price of the underlying stock can move. And if it stays within this range prior to expiration, we achieve our maximum profit. Let's also take a look at our delta. Our deltas are negative because we are selling more expensive options than we're buying. But our theta is also positive. In other words, we're going to be collecting on average 80 cents a day for every day that we hold this position. Is that linear? No, it's not a linear theta. Theta does move and tend to get dramatically larger as we get closer to expiration. That's why we don't normally sell iron condors or do our calendar spreads or do any other type of spreads prior to 30 to 40 days before expiration. Because what happens is, as we get closer to expiration, that theta increases dramatically and we collect greater and greater profits as we get towards expiration. So we will achieve the maximum profit if the prices stay within this range. Now remember though that when we took a look at the probability of touching, and we can also do the same probability up here, the probability is fairly good that we're going to touch one of these. Let's just do this here. There we go. The probability is that there's a approximately about 50% chance that it's going to touch, because we're at 51.8 here. This is approximately 50% here, that we're going to touch this 142 strike price. And on the downside, there's also a 50% chance that we're going to touch the 132 strike price, which is the maximum amount of profit that we can make in this position at expiration. So don't let the fact that the probability of expiring is very, very high for this position. In fact, it's 75%. The reality is that in most cases, the price will butt up against your break-even points and your maximum profit points at some time during the life of this trade. That's why adjustments are so critical to the success of what we're doing. Most traders, I mean especially beginning traders, will put an iron condor on like this, and as soon as the movement of the price starts to go and encroach on their break-even points, they abandon the position at a small loss. Now, if the price were, let me qualify that for a second. Let's say you put this position on today. Within a couple of days, if all of a sudden we get a huge price move to the upside and it goes to your break-even point, well, you're better off taking off the entire position. If it goes to the downside towards your break-even point, within 2 days of you putting this position on, you're better off taking off the entire position, because there's something going on in the market that has dramatically changed the tone of the market, and it's best that you step aside until you figure out what's going on, until prices stabilize a little bit. But I'm talking about traders who put these positions on, and then like 2 weeks later, you know, the price has been slowly going up, slowly going up, slowly going up, slowly going up, until it reaches closer to their break-even point, they don't know what to do. They don't know how to adjust it to continue to make profits in this position, abandon the position completely when it could have been saved and made profitable. And then they get out of the trade, they feel that iron condors are not worth it, or they don't believe that money can be made with iron condors because they didn't realize that there was a 50% chance that it was going to hit one of their break-even points. So that is basically the iron condor. And you may want to review this video several times just to understand how we do vertical spreads, how we turn those vertical spreads into iron condors, and what the difference is between buying a vertical spread and selling a vertical spread. Okay? Now, let's do one more thing before we conclude today, because we don't buy just iron condors. Iron condors do have the potential to make money a little faster in the type of position when you put those on, because the expirations are all in the same month. So the options that you sold will begin to deteriorate quicker than the ones you sold because they're both in the same month and they both have the same expiration date. The reason we diversify is because of the fact that different positions have different ways of profiting. The way we make money in iron condors is the fact that we have it's an extremely large theta. Iron condors have probably one of the largest theta decays of any of the positions that we're putting on. Other positions do not, but it also has probably a little bit more risk than some of the other positions. For example, calendars will have a little bit less favorable theta decay, but it also has a much lower risk. With iron condors, your maximum loss is actually close to the same as your maximum profit. So, but it also is limited. It's extremely limited. So in this case, we have a $45 of potential profit. Maximum loss is $55. And it doesn't matter how high this particular position goes. I mean, prices could go into the stratosphere. We'd still have a maximum losses of only $55 on this position. So it's, iron condors can be very, very safe to put on. But in order to achieve a maximum profit, you really need to understand the art of adjustments. And that's what really this course is all about, because adjustments are, in fact, one of the ways that not only we defend positions and protect positions, but also because of the way that we can rescue positions from being unprofitable to being profitable. So this is the iron condor. What is the difference between an iron condor and a calendar? Well, a calendar, instead of all of your positions in the same month, a calendar is just what the name says, is actually what you're doing is you're selling a option in 1 month, and instead of buying an option in the same month to protect it, you're buying an option in a different month to protect the sale of that option. Let's take a look and see exactly what that means. Let's go back to our trade tab, and we're going to delete this out. And if we go back into our trade tab here, we will take, let's take a look at this for a second. Let's go back to extrinsic value. We're going to take that. See, whenever you change these, it will bring up different bits of data for you to analyze here. There's lots of different things that you can analyze here. Bid size, ask size, open interest on an option, its delta, its gamma, its theta. I mean, if we were to determine the theta of these different positions, you can see that the most theta is derived from those options right around the in the money. As we get farther and farther out, the theta decreases the farther we go out. In the last example, we were going to be selling the 142 call. It had a theta of 4 cents. we were buying the 143 to protect it, so that if you subtract those two, we had a 1 cent theta on that one, and the same, we probably had pretty close to the same theta on the downside here. Let's see what we're doing. I think we were doing this one here, the 132 puts. We had a 5 cent theta on that one and a 4 cent theta on the one we were buying. So it came up to about a 1.3 theta, 1.3 cent theta that we were achieving on that position. But theta is strongest at right around the in the money options. That's where you achieve the majority of your theta. But it also has a very low probability of being successful. All right. Anyway, we can change. We can. There's a lot of different variables and information that we can receive from this position. Right now, what we want to do is we want to take a look at the extrinsic value. This is the actual amount of time value left in these options. We're going to do a very simple calendar. Remember, all the positions that we put on are based around the basic concept of vertical spreads. The vertical spread I showed you already. You're buying one option, you're selling another. In this case, what we're going to be doing is, in order to create an opportunity in which we achieve our goal of increasing theta, we are going to be selling an option that is at the money. Why would we do that? Because we want the most extrinsic value as possible. In this case, we have $2.61 of extrinsic value at the 138 strike price on the call side. We want to sell one of those to capture that $2.59 in credit. And what happens is, when you do enter an order like this, you don't actually buy this option. What you do is you use margin. In other words, the brokerage company determines what your risk is in this position if you were to sell this one option. And they would margin your account accordingly. They would eliminate that amount of money from your account so that you can't spend it, just in case this position goes against you and you need to have the available cash to buy this option back. The further this gets away from you, and the more money you lose on this position, the more money they're going to take from your account and leave it in and not make it available to you for further purchases of calls or puts. And remember, the sale of a option is called naked selling of an option, and it's extremely risky. So we don't do it. However, we do like to protect our positions. We do like to sell options, of course, but we don't like to do it naked or with unlimited risk. In a calendar spread, we know that the front month, in other words, the month that is the very beginning of the very nearest month to the expiration of this particular underlying stock, is June in this case, which has 27 days left. Now there's also June quarterlies over here, and there's another June in here. I think it might even be a weekly. I don't know what these are, but they have a lot of different kinds of option contracts. The one that we're interested in is the ones, now those aren't weekly because they have 27 days left too, but the ones we're interested in are the front months. These are called the front months. The very next expiration month is called the front month. So what we're doing is we're selling an option, and of course, because we don't like unlimited risk, we also want to buy an option, right? Just like in a vertical spread. Well, in the case of a calendar, the only difference is, instead of buying a option in the exact same month as the one that we're selling, we are going to actually go into the next month, which is July, and we are also, and then we're going to buy the exact same strike price, only a different month. So we're selling a June 138 call, and we're buying a July 138 call. Let me show you exactly what would happen if you did not buy that call in July for protecting your June, the sale of that June call. Let's analyze this. You can see that if the price stays the same or it goes down like you intended, you would collect the maximum profit. In this case is what you sold this option for of $2.59 or $259. However, because you do not have any protection for that option that you sold, you have a theoretical unlimited loss potential on that option if it goes against you. Because you sold the call option, you want the stock price to go down. But what happens if it goes up? Well, let's take a look. If it continued to go up and up and up and up, theoretically it could go to $1,000, I suppose. Although this is an index, you would have a maximum loss of $86,574, which is not a pleasant thing to have happen. So we do not sell naked options. What we want to do is we want to protect that position by buying another option at the same strike price, only in a different month. And this is called a calendar spread. They call it a calendar spread because you're buying in you're selling in one month and you're buying in another. So let's analyze this. This is what the graph of the profit potential of this position looks like when we have both the sale of the call and a purchase of the call in the next month out. The purchase of this call provides us with protection, because if the price were to move against us, we would have a limited loss on the position. Our maximum gain and maximum profit on the position is achieved at the exact price that we sold this call for, which in this case is the 138. That's the strike price of the call that we sold. We would achieve the maximum profit if at expiration this stock remained exactly at 138. We have a fairly wide break-even range here between 142 and 134 and a quarter approximately. So in other words, the price can move within this particular range and we would still achieve some profit. However, unlike the naked call, we also have limited risk to the downside. If the stock had gone up to 1,000, like we had in our previous example, the very most you could lose on a calendar spread, on this particular calendar spread, is $136. And I'll show you why it's only $136 in just a minute. Essentially, what you're doing is you're protecting the one that you sold with another one at the exact same strike price, only in a different month. So you're hoping to achieve the maximum profit in the theta decay of the front month option that you sold, while trying to maintain the value of the one that you bought in the July month. Because let me show you what this looks like if these options were put together on a graph. You can also see, but in just a second, but you can also see that theta is positive at $1.26. So even though you're buying an option, you're also selling one, and that even though they're at the exact same strike price, because they're in different months, it gives you a positive theta. Also very interesting is, unlike a vertical spread that you would sell, it also gives you a positive delta. That's very important to understand. Let's go back here for just a second. This is exactly what happens to an option as time passes. You can see on this scale is the price of the option, and at the on the vertical scale is the or rather on the horizontal scale is the time period just prior to expiration. At right around 30 days to expiration, the value of that option drops off dramatically as it gets closer to expiration. Actually, the option begins declining and decaying in value as far out as 100 days. But the acceleration really takes place about 30 days to 40 days before expiration. So that's how we make our money. Basically, those options are decreasing in time and value the closer we get to expiration, and that's how we capture our profits. Now, we can enter this as individual orders, but remember, just like our vertical spread, there's a danger in entering individual orders like this. One of them may get filled, the other one won't. And if that should happen, then we'd have a problem because we would be naked one of these options. So let's go back to our trade tab here, and let's select the month that we want to sell. In this case, it's June. We'll go to the June expiration, and in the Thinkorswim platform, it's very easy to simply right-click, and we go to Buy Calendar, and it automatically brings up for us the very next 2 months. The first month is the front month of the option expiration cycle. In this case, it's June, which is the one that we wanted to sell. But it also brought up the June quarterly options, which is the ones that we do not want to buy. We actually want to go to July. And I'll tell you why in just a few minutes. Now, the price for this calendar spread is $1.29. Let's go over to the Analyze tab. And you can see that the graph is identical to the one that we had before, in which we were purchasing the back month option in July and selling the front month option in June. The only difference is that we can enter this order as a spread order so that it will be filled at the exact same time. The maximum profit of this position as a calendar spread is the strike price that we are buying it at, which is 138. As the price moves away from 138, we will make less and less profit. However, it also has limited risk. In this case, the most we can lose is $129. And it's also the margin required on this position from our broker, because they know that the most we can possibly lose in this position is $128. And that's all that they're going to ask us to set aside to put this position on. Now, I mentioned that the position itself has a maximum the maximum loss on this position is $129, as you can see from this graph, because that's the margin requirement, and also on the graph you can see that it doesn't matter how high the price goes, it's $129 loss maximum, and it doesn't matter how low the price goes, it's $129 maximum loss. The maximum profit is if it continues to be right at the center. Then we'll collect the maximum amount of profit from this position. The maximum profit from this position is achieved at 138 because that is the option that we sold, and it also has the most extrinsic value, $2.61 in this position. I showed you the time graph. What happens is the front month of the option, and the reason that we make money on this position is that the front month option will decline in value faster than the month that we're buying. They will both decline in value if the price does not move the closer we get to the June expiration. The difference is that this option in July, the one that we're buying to protect our June position, will decline at a slower rate. The difference between the decline of the June option and the decline of the July option is our profit. And that's how you make money on a calendar. We can also discover something very interesting. In the Thinkorswim platform, you have this little box right in the center above the calls and the puts. If you click down into the this blue link here, you can actually call up all of the calendar spreads for this particular month. Let's take a look at these. Let's go back to our June options. There we are right here. June, July's. Yeah, it looks like they give us a little bit more options on... They don't give us as many options in here for some reason. Well, let's, just for example, let's take a... Oh, here they are, June, July's. I'm sorry. Okay, just got the wrong box pulled up. There we go. June, July. That's the one that we're doing. We have 37 days before June. We have 55 days to July. And the current price of the SPY is at 137. So let's go exactly to the 137 strike price. You can see that the farther out of the money on either side, the least expensive the calendar spreads become. So for example, if we were to purchase the 145 calendar spreads, June, July, that means we're selling the June 145 calls, we're buying the July 145 calls. The price that we would pay is 65 cents. Let's delete this out and just click buy on this. It automatically brings up those two options for us. Actually, we want June, but anyway. How did they do this there? Oh, they got the June 05s in there. That's why. I did have the right one. Sorry, I'm talking to myself here. Let's see. I don't know why they don't have a lot more strikes on this one. Let's see, July, August. Well, they're not going to have all the ones that we want, but I'll use this as an example, okay? And the principles are exactly the same. So let's say let's say we're bullish on a particular stock, and we believe it's going to rise in price. Well, instead of buying an outright call, we could also buy a call calendar, a calendar spread. The reason for that is, again, we have a maximum loss because we're protecting. We're also purchasing a call to protect us. In this case, it's the June quarterly calls. So what we want to do is we want to purchase a very cheap out of the money call calendar spread for 60 cents. I call this a bullish calendar spread because as the price rises towards the 145 strike level, that means the SPY would have to go up from 137 to 145. At 145, we would achieve our maximum profit. And you can see that that's true if we look at the current price of the stock. It's at 137. The most expensive call calendar spread is at the 137 strike price for $1.10. So the way we make money with a calendar is if, in fact, the price of the underlying stock expires exactly at the strike price that we've sold. So if it were to rise up to 145, this 60 cents would then become $1.10, and we would make our maximum profit. Let me show you how that looks on our profit picture. If we go to Analyze Duplicate Trade, we're going to get rid of our other one here. This is called a bullish calendar spread. The actual price, the current price of the underlying stock is down here at 137.64. In order for us to make our maximum profit, the price of the underlying stock would have to rise all the way up to the 145 strike, which is the one that we're selling and the one that we're buying. Now we're only paying 60 cents for that calendar spread. If it were to rise to 145, we would achieve our maximum profit by expiration. The most we could lose is 60 cents. With a calendar spread, the most you could lose on any of these spreads is the price that you pay for the calendar. And you can see that our margin requirement is only $60. And if we extend our graph out, you can see also that the maximum loss is $60 no matter how high the price went and no matter how low the price went. That is a bullish calendar spread. In other words, you're determining that the price is going to rise until expiration, and then you would achieve your maximum profit at the price that you purchased this calendar spread. Let's go back to our trade tab for a second. The nice thing about calendar spreads is that you can buy them just like you can with an iron condor. You can buy them on the put and the call side. So let's say you're modestly bullish, but you're also modestly bearish. You think that the prices are going to fluctuate within a certain range. Well, you could buy a calendar spread. Let's say you think the price might rise up to $1.40, but you also think it might drop at the lowest point to maybe $1.34. We don't want to sell one of those. We want to buy it. There we go. Now let's take a look at what that does to our profit picture. And I just need to take off that one that we did before. There we go. What does that do? Well, it's very interesting, isn't it? Instead of the single tent like we had before, like this one, if the price were to rise up, we would achieve our maximum profit at 104 on a bullish calendar spread. Now we also have a put calendar spread. And now we have two places at which the final price of the underlying stock could settle on expiration day, and we would achieve our maximum profit. In this case, it's 140 because we have a 140 calendar spread, and on the downside, 134 because we have a 134 calendar spread. All we did was take one calendar spread and add another one to it. Now, not only do we have a much wider profit margin, a potential for profit in this position, but we also have a little bit wider break-evens. We have 142 all the way down to 142 down to 132. If we were only to do the bullish calendar spread, then our break-even points would be at 136 and 144. But by adding the bearish calendar spread, we've extended our break-even all the way down to 132. So that's what, in fact, that's exactly what we've done here, is created a double calendar. That's exactly what a double calendar is. It's two calendar spreads, a call calendar spread, which is slightly bullish, and a put calendar spread that is slightly bearish. If we were to take off the call calendar spread, you can see that the maximum profit would be achieved on this calendar spread if the price of the underlying would move down, and it would be in our potential profit area of our calendar spread. When we put both of them together, we have a slightly wider range in which our prices can move to achieve a profit. We also have a greater theta. When we add these positions together, you can see that one side has a 38-cent theta. If we add both of them together, we have an 83-cent theta. And of course, that theta will increase in time as we get closer to expiration. So now you've been introduced to vertical spreads, the sale of vertical spreads, combining the sale of vertical spreads into an iron condor, calendar spreads, both at the money and a bullish calendar spread and a bearish calendar spread, and then the combination of the two types of calendar spreads, both on the call side and the put side, to create a double calendar. Anyway, guys, I hope this was helpful to you to understand the type of positions and how we profit from them. And I really do hope that it helps clarify, at least for some of you guys, the very foundation of what we're trying to achieve, which is positive theta positions, the spreading of a wide range of break-even points, combining vertical spreads or combining calendar spreads in order to achieve our objectives. And this is just one, I mean, we did about 2 hours today. Please review this video as many times as you feel necessary in order to really understand the very basics of what we're doing here. This is the foundation of building positions, is understanding the type of positions that we put on. We covered the iron condor, we covered the double calendar, we did calendars, and we did vertical spreads. So this is really a very important foundation for you guys to understand exactly how these positions profit, and also how to put them on, understand why we do both the sale of options and the purchase of options to protect ourselves. So if you have any questions at all about this video or anything that I went over today, please do not hesitate to ask me questions at tradingology@gmail.com. Hey, I wish you guys all the best, and go out there and trade with confidence.